Once again, hi, this is Piyush here from Caprize Investment Managers. Thank you for taking out time today to listen to a sector that we've been tracking very, very closely and have been surprised what it has achieved over the past 2, 3 years. And I think it will continue to surprise us over the coming decade as well. So before we start, just a quick disclaimer: we are a SEBI registered research analyst house, and any sector stocks that we'll be speaking on today are purely for educational and representational purpose only. Our views are very personal, and in case we manage to convince you guys in terms of our themes and the few stocks which I've used as examples, would still like you to find your own sweet spot, own sector that you can understand easily, and do your own due diligence before investing, and stick to investing which suits your personality, style, and character. Now, three key questions, or rather four. Why are we talking about manufacturing now? And when we talk about manufacturing in India, why India and why now? And in the end, the most important aspect is how do we play this sector? So first we need to understand. Now I'm going to bore you for the next 30 minutes showing you a lot of graphs and charts and data, which largely will build a thesis around why it is very relevant for manufacturing to become a very integral part of India's GDP. And I think this chart will briefly explain you that why we need to focus on manufacturing sector and what has happened to countries in Asia when they focused on manufacturing, where the manufacturing percentage increased from, say, if you look at China, it increased from 9.1% to 32%. Now that was a period of almost 25 years where the real GDP growth for China was almost 10%. It is remarkable what China achieved in that period and how it moved from being a small economy, less than 500 or close to $1 trillion to multiplying by almost 5 to 6 times. We've seen similar examples in Thailand and Indonesia. So it is important that when a country embarks on a journey where it wants to become self-sufficient, where it wants to develop its own infrastructure for a growing population, which is where we are. China was here maybe 20-25 years ago. It is very important. One. Sorry, my screen got hanged. Let me just share my screen again. Okay. So coming back to these two important charts. Now these are two examples from China and Korea, and we can see that how the GDP growth and manufacturing growth are highly correlated. Rather, in periods where GDP has grown, say by 10, manufacturing has largely grown by 14, 15, or almost sometimes twice of GDP growth. And countries with higher manufacturing percentage contribution to the GDP have always have, they've seen lower unemployment levels for a very elevated level. And economy, if we see this chart on the right, it will show you that when a country sees a economic manufacturing boom, employment rate is largely closer to 5% or below, and it's sustainable over a period of a decade or 2 decades. And India is at a place where we need to create these kind of jobs. There's a clear intention from the government that uh, this is where our focus is going to be. And now see, this is another chart which will make you believe why, once we start becoming a manufacturing hub and we start looking of manufacturing in India for the world, uh, what it does to an economy. If you look at India, it was at number 12 in 2003. China was at number 6. They saw through that manufacturing renaissance. China, over the coming decade, moved up to number 2. India was still moving from 12 to 10. And if you look at what has happened from 2013-14 to date, India has moved up massively, in terms of the entire, apart from the GDP, we've also being export, or if you look at our export growth, it would have been almost 2x of what our GDP growth has been. So as an economy becomes larger, and as the exports grow larger, I think it's much easier to grow at 8 to 10% kind of GDP growth if we have a larger export focus. Now, if you look at this, this is largely say 3.3 trillion GDP, and what is the contribution coming from manufacturing or exports? Uh, our belief is, and I think that reality will come sooner than later, that the gross value added by manufacturing over the next 6, 7 years would be far higher than any other sector. So from close to 450 billion dollars, I think this moves up to close to 1.3 trillion dollars. So manufacturing as a sector by itself will become close to 25% of our GDP, or maybe even more, depending on how well we take care of this opportunity. Now, while we see what it does in terms of how it aids GDP growth, why we think that India today is at a place where it is at an inflection point to embark on this entire manufacturing renaissance. Three key importance. Any country or any sector or any company, if you look at a company level or a sector level or a country level, there are three important things: opportunity, the capabilities, and is there a favorable environment. The opportunity is huge. We have the world's youngest population and growing at a rapid rate. We have the largest consumer base. And considering what we've seen globally in terms of geopolitics, I think we also have the opportunity to become one of the largest exporter to the world. It will be foolish to say that we are trying to compete with China. China is at least 2 to 3 decades ahead of us. But the gap, considering the kind of duties or the kind of sanctions that China is facing currently, the gap that it will create over the next 5, 7 years will be pretty huge. And even if we manage to take a smaller share out of that gap, I think the export opportunity is pretty huge. When we come to capabilities, in terms of cost advantages, and I'll show you a chart where India, in terms of the landed cost, has over the past decade performed far better in a lot of sectors versus China. We The focus has been improving the infrastructure, improving when I say infrastructure, it's not just roads, railways. We talk about power, we talk about providing impetus to a lot of industries via a lot of schemes or via a lot of subsidies. And lastly, focusing on, I think one game changer, and we'll talk about it at length, has been the focus on being Atmanirbhar, or the Make in India that we started a few years ago. I think that picked up pace. COVID was an inflection point where we saw a massive change in the stance of the government, where we saw government focusing on making defense completely indigenized, making railways completely indigenized. Then a lot of sectors we saw a lot of PLI schemes. We saw custom duties on a lot of sectors that were placed on Chinese dumping. And when a government is focused on protecting the domestic environment, uh, so if you look, what are the key vectors, apart from having a consumer base, a captive demand, and having a large skilled labor pool and cost advantage is also important that a government strongly pushes, favors, and aids this growth. So we believe that we are at a point, and I think this point has slowly been this has got better and better over the past 3 4 years, especially after COVID, and we are at a point where we'll see this massive inflection point across sectors. Another key important point when we are looking at what are the kind of corporate tax rates that India is charging versus a lot of industries. Why should they come up and set in India because of the tax rates that we have? So we'll be amongst one of the lowest in the world. And if you look at for new manufacturing facilities, the tax comes to 15%, and that will be by far the lowest across most developing or developed countries. So we are providing a sufficient incentive to manufacture in India. And as I mentioned, if you see the chart on the right, it will clearly tell you where our cost advantages lie. One key point is India's right to win globally is the low cost skilled labor. And again, just look at these two charts. We have the largest pool of labor supply, skilled and unskilled, and with the lowest, almost the lowest cost labor globally. So the cost of manufacturing, considering we have sufficient benefits in terms of tax rates, subsidies, PLI schemes, and the impetus in terms of land power, if that is taken care of, there's no reason why India will be competitive uh, with China on a lot of specialized products, highly engineered products, and to some extent a lot of what you say above average products, not a mundane product or product which do not really require a lot of precision engineering, but anything which requires certain kind of skill set. I think India has the right to win globally and will keep competing and fighting to take larger share of these products from the world. And as I mentioned, irrespective of what we export to the world, we have a crazy, crazy captive demand on a domestic scale as well. And when you look at providing scale, just look at the chart on the left. The size of the consumption, the growth, the consumption growth rate, and where we are as a percentage of GDP. I think this will aggressively magnify over the coming next 5 years to the coming decade, because as a country moves from $1 to $4 trillion kind of economy, we have been focusing on the basic needs, the essential needs of any human being. But as we move from 4 to 10 and then beyond, I think we'll start looking at consumption very differently. We want to consume better products, we want to consume better services, we want to be part of the entire value chain migration that we'll see from say wearing a bata to wearing hush puppies or a US polo, or from buying jewelry from a local store to buying from Tanishq. So this value migration or this aspirational demand that comes when a country moves beyond its basic needs is really very difficult to capture. And when you look at the chart on the right, the kind of support that we've provided in terms of whether it is smartphone, if you look at room ACs, the kind of growth that we've seen has been phenomenal. We are selling close to 1.2 crore ACs today. My sense is this sector will grow at 15 to 18%, maybe even faster, if we see power reaching every household and power becoming in terms of cost becoming very effective. So the penetration we believe is still, if you look at India's rank in the world ex China, we are still far, far behind when we talk about per capita consumption of uh, these goods like refrigerators or washing machines or ACs. So the journey from $4 to $10 trillion over the next decade will see massive growth in discretionary demand, and this will come in all these products. And we have a large captive domestic market ready to use these. Now, this is just a generalized chart of the ease of doing business, the how we've improved on logistics in terms of export volumes, how the manufacturing. So whatever we've spoken so far, This is basically a rating chart, and it measures us far better, with when we compared with other smaller economies. So a very important case in point, and this we've seen in China, and my sense is uh, India is not going to be any different. So starting 2000, MNCs used to export close to 58% of the manufacturing goods in China. So global MNCs used to have shops in China. They used to largely manufacture their products in China and export to the world. The contribution was as high as 58%. Over time, and I'm and this is not really over a period of 3 4 decades. Over a period of 15 years, local champions, local MSME, local SME, local companies became so large that today they contribute 66% of China's manufacturing export. And this essentially means that massive wealth will be created amongst a lot of small, mid, large players today, which are on ground manufacturing these goods. And key question then remains is, will we see a similar trend in India, which we believe we will? So why act on it today? Why now? Now, this is a basic journey of India's manufacturing, the post-independence era. Again, as I said, roti, kapda, makan was a focus. The focus was on primary industries, largely driven by PSUs. Then we saw the entire liberalization era starting 92 to almost, this era would be, say, another 15, 20 years. Again, industrial growth was led by MSMEs and consumer goods, and we saw a lot of real estate demand, infrastructure demand, power demand, a lot of import growth that we saw because as a country we were growing for basic needs, and we weren't really capable to manufacture at that kind of scale. So we saw a lot of competition from global players to come and set up their shops in India. Now, what has happened post 2014, and more importantly post 2020, India was the only country which really did not dole out a lot of freebies. What we rather, what the government rather focused on was, how can we aid this growth? How do we provide subsidies? How do we provide PLI schemes? If you think about PLI schemes, if you look at 6 to 7 years of PLI schemes, the government says that if you achieve 6 lakh crores of revenues from select industries, we will give you 1.5 lakh crore as incentives back. Now, to generate a 6 lakh crore kind of revenue, considering 1.25, 1.5 times asset turn, we are essentially talking about capex of close to 2.5, 3 lakh crores. And government is saying, I will bear 50% of the capex. You grow aggressively, become cost competitive, eventually generate that kind of growth, profitability, and pay us the taxes back. But think about it, that for a company where a project was not feasible at, say, 12%, 14% IRR, today the same project with 50% capex contribution coming from government, the ROC suddenly shoot up to 25, 30%, and making the project extremely profitable and successful. A simple example, if I have to give, and again, don't take it as investment advice, is Archin Chemicals, ACI. Now, they have bid for a 3,000 crore scheme of the capex that they plan to do on the semicon side, and they've hired the best people in the industry. The capex will be close to 3,000 crores, where government's contribution will be as high as 750 to 1,000 crores. Now, this completely changes the way a company looks at a sector product, and eventually, completely growing at 25, 30% ROCs, and, successfully executing a profitable project. So, post 2020, we see, we meet a lot of companies, a lot of larger industries and sector leaders. And the only feedback that we got from them is that post 2020, the push that has come on local manufacturing has been so phenomenal that in terms of, whether it was clearing off a lot of pending projects, clearing of a lot of pending files, all these happened very quickly, especially in sectors like railways, defense, and manufacturing. And the whole ball was of course set in motion with the Make in India scheme. But what helped was China plus one plus COVID, and the massive push by government saying we will give you incentives. And these incentives were not for large corporates. We saw, if you look at the number of SMEs that have got listed over the past 2 3 years, a lot of SMEs within the manufacturing sector were able to sustain and rather grow at 25-30% kind of earnings growth because of these PLI schemes that help them. And so this is largely, if you see a snapshot, it's just a snapshot of PLI schemes and their impact, which I already spoke about. And if you look at how defense exports have grown over the past 5 years, it has multiplied by 4 times already. And our sense is that from here to it will multiply by another 4 times over the next 6 years. Which, if you look at the growth, is humongous. And uh, what it does is, if you look at, I'll show you another chart. So these are where the new projects are, new projects have been scheduled or announced. And when manufacturing growth is much higher than GDP growth, we saw a chart at the beginning how it adds to the gross value added to a country, or how it actually aids in much faster growth for an economy. And so if you look chemicals, electronics, metals, autos, textiles, these are the sectors where we've seen massive announcement in terms of corporate announcements on the project side. And look at what has happened over the past, the kind of growth that we've seen in terms of shares of manufacturing sector in new company registrations, and the kind of FDI that has come into manufacturing. And that is the reason, uh, if you look the kind of fundraise that has happened over the past 2 3 years, is largely because each and every company is talking about capex. You look at private capex spending, the way it has moved up. And if you look at the defense government capex, you look at capex from the central side, state side, listed corporate capex, each and every segment, sector, state has seen this massive jump or massive growth. And in terms of the expenditure budget, over the last 3 to 4 years, we've seen a massive increase in the capital expenditure budget as well. So this got also aided by the easy capital availability. So, we've continuously in our social discussions have talked about how, for a company to be successful or a sector to be successful, apart from having a very ambitious and skilled promoter, access to capital is extremely important. Now, considering this capex is coming up, the government provided that access to capital, or the capital markets provided that access to capital. Now, look at the sectors where we are also focusing on currently is power, defense, semiconductors, oil and gas, steel, water infra. We've not mentioned recycling, but that will be another sector which I think is a sunrise sector. And the kind of investments that we'll see within that sector, I think, could be mind-boggling over the next 5 to 6 years. Uh, Also, India's attempt to export to the world. Now, just look at the merchandise exports and the service exports, and the kind of growth that we've seen in merchandise exports over the past 3 4 years. And going forward, we will continue to see in terms of our share going up massively. So if we are close to 1.8% export share, we won't be surprised that over the next 6 to 7 years we double our share, which means that most of the industries within the ancillary industries or a lot of smaller companies will grow at 25-30% kinds of earnings CAGR over the next 5 to 6 years. And again, a quick snapshot how the exports surged to $450 billion in FY23. And the pre-COVID level was close to $330 billion. And we saw a big dip. And then I think we'll see a sustainable 12 to 15% kind of growth in India's exports. Now, coming to the key question, how do we play the manufacturing theme? These are largely the sectors of interest. And if you could just quickly take a look, there are 7 to 8 sectors that we are largely focusing on, and we will talk about them very uh, in terms of briefly. So three themes that we like to consider. The first is import substitution, where the government wants products to be manufactured locally, uh, either 100% or 50% or at least 30% indigenization, which is where capex is happening. The second is export promotion, and the third being domestic consumption. And again, this again shows you which part of these themes will take a larger piece. So the consumption share will go from almost $2 trillion to $4 trillion over the next, as we see the country moving rapidly over the next, by till 2030, maybe close to $7 trillion of GDP. Manufacturing will become 1.2 to $1.5 trillion of that piece, and consumption will become close to 4. So, services has always been a very strong force that India has been recognized. India is recognized as being a service economy. I think these two pieces will completely transform the way the entire pie looks over the next decade. Now, when we come to import substitution, or which essentially means that you need to put up more and more domestic manufacturing units and have more skills and more abilities at a domestic level, uh, we will be seeing these themes play out in sectors like chemicals, electronics, manufacturing, and we've already seen, when we talk about the growth in air conditioning, the low penetration level in a lot of white good products, or even uh, you know in terms of manufacturing, we are still seeing a lot of equipment being imported in terms of basic CNC machines. Uh, so these are the companies that have been on our radar. When we talk about electronics, we met RIR Power just day before yesterday. They are all set to inaugurate a large silicon carbide plant in Odisha in the coming week. Uh, so there are companies like RIR Power, there are companies like Ember, Dixon, Keynes, which have been at the forefront, of this manufacturing renaissance, which largely are, they're focusing on the domestic growth. Most of the larger brands or larger MNC players are passing on, they're taking care of the marketing and servicing, while the entire manufacturing piece of the domestic consumption demand has been on the shoulders of the likes of Ember, Dixon, and Keynes. Coming to manufacturing, any CNC machine, if you've ever looked at it, forms the heart of a manufacturing process. So companies like Mac Power CNC, Jyoti CNC, or companies producing larger CNC machines like EMMIL. We've uh, been very bullish on a lot of infrastructure related projects, and pipes will be one sector, where we'll see a lot of what you say pivoting from not just having certain infra related need, but at a very commercial scale, retail scale, real estate scale, we'll see pipes migrating into the structures. When we talk about defense, I think this industry is almost more than 20 lakh crore kind of industry. I think we would have indigenized close to 5 to 6 lakh crores. There's a huge opportunity that we are still looking at. And forget, when I talk about indigenization, this is just domestic demand. When we start exporting, this opportunity size is far, far bigger. Of course, the valuations might not give you comfort here, but there are a lot of small niche companies. If you can identify 3 to 4 names and certain skill sets and build a basket around these 3, 4 skill sets, I think defense is another sector where we'll see a decadal run. And largely coming to EVs, whether it is EVs or hybrid vehicles, or the entire charging infrastructure that we'll see, I think there are a lot of smaller companies which have been traditionally largely focused on the old engineering or old manufacturing ways, are rapidly moving towards manufacturing products for the EV segment, either by acquiring these skills by making acquisitions, or developing these skills in-house via R&D. And these are largely the companies that we believe will see massive growth. if one, of course, the capital allocation is right, and two, they manage their working capital well. Because large part of manufacturing companies, the only issue that can run them down is the working capital piece. So these are broadly the five sectors. There are a lot of companies that we mentioned. These are purely again for representational purpose. We of course have holdings in a few of these names, but we've been tracking all these companies very, very closely. This is again just a chart which shows electronics imports to export ratio which continues to decline, which essentially means that India is becoming more and more self-sufficient and has over the past decade this has gone from 9.3 to close to 2 now, and I think we'll take it below 1 over the next 5 to 6 years. A case in point, I think uh, around 2015-16 was a time when 95 or 98% of the cell phones that the country used were imported. Today, we've completely reversed it, and it has taken us less than a decade to now suddenly manufacture 99% of the phones that we use, and of course we export. So, which essentially means that the local production, the local cost, the local skill set was there, and a lot of companies took full advantage of that. And we can proudly say that we've been as cost competitive as China has been. That has also been precisely the reason why we saw this massive shift. Coming to the second theme is export promotion. And sectors, there are a lot of sectors that government has been emphasizing in terms of increasing trade, and government has been pushing them to build capacity to meet global demands, whether it is telecom, whether it is auto parts. I think solar energy components is one piece where again India will be at the forefront in terms of exports. Wari exported 70% of its modules last year. They're also setting up a facility in US. Premier just law got listed, and we've seen the kind of work that they're doing in terms of exports. Adani, in terms of their solar module piece, have been exporting 100%. A lot of transformer companies that we've spoken to, and we have transformers in our portfolio as a basket, have very rapidly increased the export share. The demand, of course, there's a massive demand uh, locally, and most of the companies that we on the manufacturing side, power side, we've spoken to, they said that we've never seen this kind of demand on the transformer side, and it's been a decade since maybe a polycap or a transformer rectifiers or a shilcher has been late in meeting their demands or not taking fresh orders, largely because the kind of demand that they've seen. So forget domestic demand, but transformer was one sector where we saw that it was apart from of course a lot of local tailwinds in terms of the rise in power and solar and EVs. uh, there was a massive what do you say change of replacement demand that we saw globally in Europe or in US. We've not seen a lot of power capex in these developed economies for almost 5 decades, and suddenly all of that is coming up for replacement. There is renewed demand in the US, so most of these transformer companies have started exporting to US, and I believe that this trend, again, this is not my personal learning, but promoters within these companies and been in the transformer space for almost 30 to 40 years have told us how cycles work here, and this is one cycle. The down cycle lasted from 2008 till 2021, and the next leg of cycle there's believe that will last from 2021 till 2032 to 35. So that is the kind of cycle that this particular sector enjoys, and we believe we are at step 3 of 10 when we have to look at where we are in terms of this part of the business. Then of course coming to pharma, we've seen if you find time to listen to broadly, 3 to 4 conference calls on the pharma space, and how they are, building their skill set on the manufacturing side, whether it is contract manufacturing, APIs, or CRAMS. Just go through conference calls of Marksans Pharma, Shilpa Medicare, Panacea Biotech, or Wockhardt, which we are tracking very closely. And look at the kind of growth they believe they'll achieve, look at the kind of export markets that they are targeting, and we've seen similar trend. And so textiles have always been largely export oriented, but we saw how the growth tapered over the past 5 to 7 years. We are seeing a large part of this growth coming back in the textile space. And we've spoken at length on electronics and how now global players are setting up their manufacturing units in India, and largely Ember, Dixon, PGEL, Keynes, and the large part of EMS group, EMS services group has been at the forefront in terms of taking larger load from them and exporting their products to the world. So again, these are few sectors that we are tracking very closely. And on the auto part side also, if we had visited RK Forging's plant up almost 2 years ago, and the vision was very clear. They were already exporting close to 40% in terms of their revenue share in exports. But they were very clear that this will go to 55, 60% because the kind of work, kind of precision engineering that they are offering and the cost that they are offering at. And if you ever get a chance to visit their new plant, you will be amazed what kind of technical skills a company can have, or an Indian company can have such a brilliant model, whether it is Bharat Forge or RK Forge. Same goes for Balu Forging, which exports 88% of its products. So you'll find a lot of these, essential precision engineering companies. Of course, you'll have to get the valuations right, but you know, we have a lot of skill which we sometimes fail to look at, and these are the companies that have exhibited these skills. These are just a fraction of those companies. Unfortunately, I could not mention a lot of other names, but these were the ones that we've looked at closely or have been currently invested, or were invested at some point of time. And again, when we talk about export promotion, China has lost share in US imports, while India has been the one which is benefiting on behalf of China because of the sanctions. And I believe that irrespective of what government comes in the US, uh, India will be slightly favored, if not a lot, versus China. And as we scale up in terms of our manufacturing process and with government incentives, I think this gap will get much wider. Just a case study, again, not mentioning the name of the company, but this is one company where we saw export revenues move from, say, uh, close to 24, 25 billion to 73 billion. And, the performance for that company, because the export revenue came at a much better margins, ROEs and ROCs, in the same period, the stock price would have multiplied by almost 15 times. Another case study where auto vertical focused ER&D company, as the market share moved from 11% in 19 to almost 20, and I think they'll close at 23, 24% next year. The share price of this company multiplied by almost 16 times. So what export does in terms of revenue diversification, bettering the margins, improving your ROE and ROCs, and when you compete with global players, you also bring global skill set within the company, and which is why you get a better multiple. And last part of our theme on manufacturing is domestic consumption. And when we talk about consumption, it is not just basic consumer discretionary items, but I think we've moved beyond discretionary, non-discretionary, and we are focusing purely on consumer discretionary as a segment. When we talk about consumer durables, I believe there is, and I'll keep saying this, that we have massive opportunity within the white goods space, whether it is IFB, Whirlpool, Voltas, or players who actually sell these on ground like Aditya Vision or EMIL. I think this is one segment which will surprise everyone. Any player who's very efficient in this, maintains their market share, margins, profitability. I think over the next 5 to 6 years, we'll see the multiples also expanding dramatically. Then, of course, when we've seen a huge real estate boom over the past 2, 3 years. I think with this rising aspirational value, rising income levels, we'll see more and more organized real estate players, growing rapidly over the next decade. And when we talk about real estate, we of course will look at sanitary ware, plywood, MDF. where the capacity industry might be at an overcapacity right now, but the rate of increase in terms of the gap has slowly reduced, and we believe that in the next few quarters we will have formed a base within this space, and there'll be a lot of opportunities that will be available. We already, if you look at Greenply numbers and just go through their conference call as well, I think we'll get a broader idea of what I'm trying to tell you. Then when we come to luxury goods, or rather discretionary spend in terms of autos, hotels, jewelry. If you could look at, either you buy retailers like Titan, or you buy manufacturers, contract manufacturers like Sky Gold or Utsav. When you look at the local alcohol industry, the manufacturing side, either you look at ABDL, Piccadilly, of Indri Frame. So hotels, autos, we'll be seeing a massive growth in terms of the number of keys when we talk about hotels, or you know even in autos we've been seeing that, while the sub 10 lakh or sub 15 lakh market has been very very weak, if you look at the larger bracket in terms of the luxury positioning, I think the growth has been phenomenal. And just look at, again, when we talk about consumption, we need to see how the curve, is burgeoning at the center, and how large part of middle class, the lower middle class will move to upper middle class, and we'll see a huge value migration from the low income levels as well, and how upper mid and lower mid will form the largest piece within this entire consumption space. And this demand shift, will result in a huge growth in most of these sectors, whether it is fashion, luxury goods, watch manufacturers like Ethos, or secondary car sellers or luxury car sellers like Landmark. We've already been witnessing the kind of growth in, not just in primary sales of luxury vehicles, but also on the secondary side. So, this is automobile sales which have largely grown in step with national income. And I was mentioning, how the hatchbacks, which is like the sub 10 lakh segment, has not seen that kind of penetration, but the the SUV segment has grown phenomenally over the last 3 to 4 years. So, final comments before we take a few questions, that Make in India was a game changer, and the effects are visible in, the cables and wire space, the chemicals, pharma, power, oil, gas, metal, ancillaries. And each of these subsegments have some phenomenal companies that have grown very very efficiently, by allocating better, by growing in a profitable way. And we would like to cover each of these themes at length, in more of such sessions. Coming to PLI schemes, we believe that this has been a masterstroke by the government, and they've fostered the manufacturing animal spirits across sectors. We've seen what has happened. If you look at just defense, the kind of market cap realization that we've seen over the past 5 years has been phenomenal. Railways has seen a similar trend. Renewables is, again, we believe the runway is a decadal. We'll see a lot of new beautiful companies emerging within the renewable space, and thanks to PLI schemes, that these sectors will see those kind of growth at amazingly good ROCs and ROCs. Again, a framework rule that we have, and I've always mentioned in most of our calls, if you find a company which is growing at 20-25%, and it is growing while it makes ROCs of 30-35%, it is a company that should never move out of your portfolio as long as these two conditions hold true. Then, of course, COVID was a huge advantage for us. China's loss was our gain, and it completely opened up India's manufacturing component ecosystem. And India, of course, happily adopted whatever came its way. They imposed a lot of restrictions to Chinese dumping, because the demand there was falling off the cliff. And one important thing to note here is that when we try to impose a lot of duties, as being part of the global channel or WTO, we cannot really increase duties on a lot of products the way we want to, or ban a lot of products coming from other countries, because China will find its way from one or the other country. What India is now doing, this is very essential to understand, is that we will have our own Indian standards. So, say China is coming at a scale of 1 to 10, coming at a standard product of 6.5, 7. What India is saying that we will set a normal Indian standard, which will be 8, 8.5, 9, or anywhere above the Chinese standard. A country can have its own standard for its own people. No one can stop a country from deciding their national standard. That way, we are not biased. We are welcoming anyone who can maintain that kind of standard. And while if we want to lobby with the WTO to increase duty on certain product or segment, that thing can go on for years, while we lobby. But when we come up with the Indian standard, this can be done in less than a year while enjoying the same benefit. So I think this is something that the government has been uh, aggressively pushing across industries, and we will see the effect of this Indian standard uh, over the next 3 to 5 years. And largely, government is focusing on developing a lot of component related to manufacturing of semiconductors, data centers, renewable, recycling. I think recycling is one theme which is where so solar, where solar was close to 18, 19, 20, recycling is there with the EPR norms coming in, which essentially means that enhanced. So the producer has a social responsibility. So if they are, say, a Samsung sells 100 mobile phones in a year, they have to bring back 50 of those pieces back into the system, in their own system, and recycle it. Of course, they cannot do it. So they need players who do it for them, whether it is wastewater treatment or whether it is recycling or whether it is power. I think India is at a inflection point where most of the industries also understand the kind of opportunity that lies in front of them. They have the access to capital, they have the skill set, and we believe we'll see the biggest wealth creators within these sectors. So I think that was a very long presentation, but it was very important that we share why we believe that this sector will do very well. Uh, I will quickly look at the chat box and see if there are any questions that we can take. Uh, Pankaj Tiwari mentioned that my query is related to telecom infrastructure as we are witnessing tailwind in the sector. How do you see this sector and any company that you love to have related to telecom infra? So I think the number of towers will more than triple over the coming decade. A lot of good companies doing good work within that space. Suyog is something that we watched very closely and we own it as well. So I'm biased there, but I think that is one company where we believe that the market cap could multiply multifold. And in one of the, so again, Naman has in the presentation you estimated Wari Energies will post 3,500 crores in FY26. Do you expect any revision in estimate? Uh, I think that solar is one sector where we are happy to go wrong in terms of estimates because it will largely be on the, it will surprise us on the upside. So we believe, yes, we will have to change our numbers. And then you said, just like Western countries have applied higher tariffs on Chinese goods, there will be a possibility of such tariffs to Indian companies as well. Of course, Karthik, there's a strong possibility that will happen, and we might see that from US. But we still will be at a much better advantage. I don't think that the duties or tariffs on China has been more because of the kind of in terms of the labor norms that they've been violating. We are not doing any such thing. So my sense is we'll still have an advantage. Most countries will still try to protect themselves and have some tariffs. But my strong belief is that the tariffs on India will be far lower than in China. And Ashish Singh asked, how do you get comfortable with extreme high valuation in these sectors like solar or EMS sector where PE is trading at above 80? What's your strategy and what do you think valuation will remain here? Uh, Ashish, this has been a question that bothers us as well. And incrementally fewer and fewer ideas pass through our framework and filters. But when you're looking at sunrise sector, whether it is solar or EMS, you have to look at the longevity of growth and look at what they are going to do in FY26, 27. Because if you look at FY25, everything will seem expensive in these sectors. These sectors are growing at 40, 50% CAGR, generating more than 35, 40% ROCs. and something like this happen for a sustainable period, fees also remain very elevated. This is something that when India or old school investors are not used to, which is also why a lot of social media angst against such IPs. And while I am a strong believer that on if you look at a decade, say if you look at decade and Nifty, if you look at Nifty's growth at 13%, the Nifty earnings CAGR has also been 13%. So if you look at a decade or if you look at 5 years, sometimes it's very difficult to look at that kind of horizon. But say if you look at 3 to 5 years and you believe that kind of growth is achievable over a sustainable period, fees will remain elevated. You have to find these companies at times of distress. In every year or two market, there are times when these companies will also fall 20 to 30 to 40%. Those are the times that you'll have to get your have to have we keep our lists ready, and we have 15 to buy names always on our pad. In the entire year, we only have 3 to 4 names which come at a buy price, but we are happy to let go. There is enough money to be made in a lot of better ideas. So yeah, what do you think about AC manufacturing sector? I spoke about that. Okay, a lot of new messages. Gold price is increasing, so can Indian companies in mining space do better? Honestly, this is one space that we've not seen, so very difficult for me to comment. Um, One sector considering what scarcity going ahead in any input, especially for recycling sector. I didn't understand that question, Himanshu. Um, I think water and waste. These are two sectors which will be gold mines for the coming decade. As population rises, as aspiration rise, these are two basic needs that need to be taken care of. More and more companies are doing good work here. We met a lot of unlisted companies here, and they are doing some phenomenal work. There's a lot of what do you say, a lot of companies focusing on select niche, whether it's say a sewage treatment plant or effluent treatment plant. And I think this is one space where almost all of the companies that are in the listed space will do well. So we are in the process of doing a detailed session on waste to gold, which is basically your whether it is wastewater treatment or recycling. We'll be doing something on that, and how to associate with Caprize in small case only product. I think we have two products. One is the earnings momentum product, and one is the mid cap and thematic. These are the one companies where we believe there are strong inflection points where earnings will double over the next 3 years, and so should our portfolio. And Kevin Lakshmanan has asked a few times, what about space sector? Many innovation is coming, and honestly, there are very few companies that have the skill set. Walchan Nagar is doing some preliminary work there. Azad is one company that is doing very, very well. So do look at that. What about steel sector? My question was earlier. I think can you steel sector? So I think steel sector there's a massive capex going on there. Again, we are focusing and we've done a detailed video on Krishka staffing. So we are trying to find ancillaries, because what happens is when prices fluctuate, which of these companies will maintain their margin, which will not, we are not sure. But we are trying to find a lot of ancillary companies which will support these sectors where there's massive capex happening. And just a few more questions. Are you tracking Nebe? What in defense forum, he told to do 1,000 crore in FY25 versus 250 in FY24. Yes, we were participant in the preference issue of Nibe at 365. We continue to hold it. Uh, we believe that the kind of partnerships that they've engaged in, again, it's so difficult sometimes to build in numbers and estimate, because you know every time we build an estimate, we've gone wrong, and I think we've just let it go into the theme where we believe that the growth will be upwards of 40 to 50% for the next 3 to 4 years, and I think they will do a great job in that space because they have the right products, they have the right tie-ups. Happy Teachers Day to you, to Anuj Arya. I've been tracking you guys for some time and learning this space. Strongly resonate with your thoughts on recycling space. Apart from Gravita, Rudra, there are a lot of companies in the recycling space. There's rubber recycling. We've seen High Green. There's GRP that got listed. We are looking at a lot of e-waste recycling companies on the unlisted side. And on the listed side, unfortunately, we don't have a lot of options, but you'll find companies in, as you mentioned, Gravita and Rudra. There's Ganesha Eco. Again, the valuations are such that will make your head spin. But try looking at these largely, in corrections. But again, Gravita surprised us. We never thought we'll make 10x in 3 years. A lot of companies within that space will see similar fate. So keep your eyes and open here. We'll be doing one session on this in detail. So Pawan Kataria mentioned Pondy oxides is into lead recycling, but do valuations give comfort? No, valuations are not comfortable for most of these players. Pondy as a smelting, it's a, whether you're a smelter or a recycler, valuation actually is they're getting is of recycling, whether while they are a smelter. So be careful where you enter at valuations. Markets, of course, I will not say that markets, you can just come in today and invest in markets. It's a very difficult market. We've seen some crazy returns over the past 3 to 4 years. And again, my basic request is that uh, just do some due diligence before you invest in a company, because in any market correction, you let go of your winners, and be mindful of what valuation you want to pay, and invest in companies or sectors, or invest in a way which resonates with your personality, your investing style, your character. And is very, the frequency is similar to how you are as a person. So very important how you choose your investing style. uh, Someone answered, can you mention the mining sector has great future? I think this is very government regulated, and time and again we've seen mines being given. Ashapura mine game is a classic example. I think a decade ago, they were given mines from Gujarat government. They made close to 200-300 crores of investments, and the government took them back, saying it is in national interest. We cannot give it to you, and the company almost became bankrupt. So I will stay away from these sectors. Things might change, but we try not to be, while we are reliant on government when it comes to PLI schemes, when it comes to schemes like, say, ALMM solar, but in terms of mining, we'll try to stay away as far as possible. Let me take, thanks Piyush for answering my question. If you can answer, when do you think Vari Energies will get approval for IPO? No idea, honestly. Anyone's guess. Hi Piyush, thanks. Presentation was very informative. Thank you for providing insights on. Can you provide green hydrogen space and co-lending co-origination models? So when we talk about green hydrogen, we are still at a very nascent stage, and we are seeing rapid progress in a lot of companies. They are trying to tie up with a lot of Chinese companies. Our own technology here is not really impressive as yet. So while we will see a lot of wealth creators within this space, what we are trying to do is play this by the EPC guys who will basically execute for these guys. And on the co-lending, co-origination models, we've stayed away from, honestly, BFSI, banking, financial. I don't. In the last decade, we maybe not owned more than one or two banking names or BFSI names. So we've always stayed away. That is something that we do not understand. We like to bet directly on businesses rather than banking on people who lend to these businesses. I think a business that's successful will make far more money than a financier who's lending to these businesses. So thank you, everyone. Thank you so much for attending this session. I hope this was very helpful. Would like to have your feedback on how the session was, or what is something that you liked, or what is something that you felt was missing. And we will try our best to address this in the upcoming sessions, and let us know where we can improve, and we'll try our best to add as much value as possible. Thanks again for spending this hour with us.